Welcome to This Explainer. Today, we're diving straight into something pretty mind-blowing. We are going to deconstruct one of the most misunderstood, yet absolutely crucial mechanisms in modern finance, where money actually comes from. I'm super excited to guide you through this, because once we peel back the curtain on the accounting and the gritty reality of our financial system, you are never going to look at a bank loan or even the balance sitting right now in your checking account the exact same way again. We're talking about a massive paradigm shift that rewrites the rules of wealth, debt, and really the entire global economy.
So let's just jump right in and challenge a textbook belief that almost all of us hold. We all grow up with a very specific mental model of how banking works, right? It feels intuitive, and it totally shapes how we manage our own money. When you open your banking app, you probably picture a digital vault holding your specific hard-earned cash. But what if that foundational assumption is completely backwards?
Look, most of us were taught the exact same story in Econ 101. It's the traditional money multiplier theory. In this old story, you deposit $1,000, the bank keeps $100 in their vault just in case, and lends out the remaining $900 to someone else. It paints banks as just simple financial plumbers, basically taking existing money from savers and passing it along to borrowers. It's a neat, tidy little story.
But here's where it gets wild. Researchers and major economists, even folks at the International Monetary Fund, have pointed out that this textbook intermediation theory is actually factually incorrect in the real world. Everyday commercial banks do not simply intermediate loanable funds. They aren't just taking your saved cash and handing it to the next guy in line. Instead, we have to look at the disruptive, somewhat shocking reality of the credit creation theory, which tells an entirely different story about what's happening behind the scenes.
Which begs a massive million-dollar question. If banks aren't just shuffling existing savings around, then how do loans actually get funded? If there isn't some big pool of pre-existing money waiting to be doled out, where exactly do the funds for your mortgage or a massive corporate loan actually originate?
Well, the answer has kind of been hiding in plain sight. Back in 2014, the Bank of England openly published a landmark report plainly stating that commercial banks are the true money creators in our modern economy. They don't sit around waiting for a saver to drop off cash before they issue a loan. They lend first and look for central bank reserves later. When you get approved for credit, the bank simply creates that money by typing it into existence as a brand new deposit under your name. And to take it a step further, economist Richard Werner actually proved this empirically. He took out a €200,000 loan and literally watched the bank's internal accounting systems in real time as the transaction went through. Guess what he found? The bank didn't transfer funds from another saver, and they didn't pull money from a central bank reserve. They literally just credited his account. The money was born the exact second the loan was finalized. As Werner put it, it's created out of thin air, like fairy dust.
So the big takeaway with the credit creation theory is that commercial banks possess this incredibly unique power to expand the money supply simply by extending credit. They are absolutely not neutral middlemen. They are the actual source of new purchasing power in our system. Every single time a new loan is issued, whether we're talking about a student loan, a car loan, or a billion-dollar corporate credit line, new digital money enters the economy. Our entire economic cycle is fueled directly by this very mechanism.
Okay, but how does this magic trick actually work without breaking the law? To understand that, we have to ground it in the cold, hard mechanics of a bank's balance sheet. Printing money sounds wild, but it is strictly bound by the rigid rules of corporate accounting. It's not just a free-for-all. There are precise ledger entries that make this mathematical expansion possible. It all comes down to the beautiful of double-entry bookkeeping. This perfectly illustrates how purchasing power is created without any prior transfer of funds. When a bank issues a loan, it records an asset on its books as a debit. That's your loan agreement, meaning you legally owe them money. Simultaneously, it records a liability as a credit, and that is the brand new deposit they just dropped into your checking account, ready for you to spend. Both sides of the balance sheet expand at the exact same time. It balances perfectly. New money is created without needing a single cent of pre-existing savings.
Now, I know exactly what you're thinking. If there's literally no technical limit to creating deposits, why on earth don't banks just lend infinitely? I mean, if you or I had a keyboard that could legally add zeros to our checking account, we'd probably never stop typing. So what actually puts the brakes on this whole system?
Well, they do have some pretty strict regulatory speed bumps. A major one is the Basel III liquidity coverage ratio. Regulators basically want to ensure that if a rumor starts and everyone rushes to withdraw their cash at once, a classic bank run, the bank actually has enough safe assets to survive the panic. This ratio forces banks to hold enough immediately accessible, high-quality liquid assets to make it through a severe 30-day stress period without totally collapsing.
To pass this stress test, banks have to secure and stockpile these specific assets, which are categorized by risk. Level 1 assets are basically a risk-free stuff, like central bank cash or government debt. Level 2 assets are a bit riskier, like residential mortgage-backed securities or corporate debt, so regulators apply a haircut, meaning they discount their value for emergency purposes. Because banks must acquire these specific assets to legally back up their balance sheets, they simply cannot expand their loan books into infinity. It acts as an anchor.
But beyond the regulatory red tape, the true limit on credit expansion is just the bank's own self-preservation. It's their assessment of future profitability and the risk of borrower defaults. Even if regulators give them a green light, a bank isn't going to conjure up a loan if they honestly believe the borrower can't pay it back. If a loan goes bad, the bank has to write down its own core capital. So, the ultimate constraint on our money supply heavily relies on the banking sector's appetite for risk and finding enough credit-worthy borrowers.
All right, let's zoom out a bit. What are the macroeconomic consequences of an entire global economy that relies on this constant credit expansion just to function? Understanding the accounting is great, but seeing how this structurally shapes our society, our asset prices, and our business cycles, that's where things get genuinely fascinating.
Think about it. Because banks inject brand new money into the economy every time they lend, this tidal wave of credit frequently ends up chasing a limited number of assets. That newly typed money doesn't just sit in a vault, it flows heavily into stocks, bonds, and real estate, pushing those prices higher and higher. According to this theory, what we're seeing isn't always an organic increase in value driven by productivity. Often it's just an inflation of prices driven by the sheer volume of new, debt-based money desperately looking for a place to go, inflating massive historical bubbles along the way. And when those bubbles inevitably burst, central banks typically rush in to slash interest rates and flood the banking system with reserves to try and stimulate even more commercial lending. Now, it's really important to note that central bank reserves don't directly enter the real economy as money you and I can spend at the grocery store. Instead, by making funding cheaper strictly for the commercial banks, the central bank signals that the system is stable, essentially encouraging them to fire up that commercial money creation engine all over again.
They step in so aggressively because central banks are absolutely terrified of deflation, and for good reason. In a system where money is literally created by taking on debt, a wave of mass loan defaults actually destroys the money supply. As existing loans are paid off, or worse, written off in bankruptcies without new loans replacing them, the actual quantity of money in the broader economy rapidly shrinks. This contraction can lead to a devastating systemic economic spiral that policymakers will do literally anything to avoid.
So, this brings us to a really critical crossroads. What happens when households hit peak debt and governments are running persistent deficits? Our financial system fundamentally requires constant credit expansion to maintain growth, support asset prices, and keep people employed. But structural limits eventually show up. What happens to the broader economy when borrowers just can't afford to borrow anymore and lenders lose the appetite to lend? To keep the illusion going and dodge that deflationary spiral when everyday borrowers are tapped out, policymakers theorize and sometimes deploy some pretty extreme alternative tools. This might include pushing interest rates into negative territory to penalize hoarding cash, rolling out central bank digital currencies, or injecting funds directly into the public through universal basic income or massive infrastructure spending. These are all mechanisms designed to just keep the credit engine humming when the private sector hits the wall. As every new loan births a brand new digital dollar, the ultimate question we have to leave you with is this: how sustainable is a system where wealth is increasingly just a reflection of credit expansion rather than actual real-world productivity? The mechanics of money creation dictate the very shape of our lives. Think about the assets you own, and remember they are tied to a system that literally types purchasing power into existence. Thanks so much for joining me on this explainer, and I hope it gave you a completely new perspective on the financial world around us.